I'm going to then now just give a little bit of a breather in the sense of starting the fireside chat and call our delegates to the front.
Thank you for giving us your time today. And I'm talking to a dynamic young man. He looks young. I don't know. His name is Daniel Goldberg. And Daniel is the founder of Bridgement, a FinTech company. And the purpose of this discussion is to figure out what it takes to start a FinTech company in South Africa or in Africa. What your mindset should be, how you set goals, and how do you find gaps in the market. So to get started, let's start with your founding story. What inspired you to start Bridgement, and what gap did you see in South Africa's SME lending market?
Yeah, thanks very much for having me here today. Really good to be here with everyone. I think the idea came from a bit of a long-winded journey. I had a background in engineering, biomedical and electrical engineering, a lot of experience with software and artificial intelligence, but I ended up working in banking and management consulting, both in South Africa and in Nigeria. And it was off the back of that I had some first-hand experience and got to see how small and medium-sized businesses tended to be overlooked and underserved by the traditional banking sector. So it was off the back of that, while being exposed to that, I thought, how can I leverage my experience in tech, in software, in AI, to create a better, simpler way for businesses to access funding. And so essentially I ended up down this FinTech journey. I was involved in another FinTech prior to Bridgement. And during that time, as an early stage business, we had some first-hand experience on how difficult it was, one, managing cash flow, and two, accessing funding from the traditional banking sector. It was off the back of that I started to learn and read up on the SME finance world, and I discovered that there was this huge credit gap, estimated at anywhere from 86 billion rand up to 300 plus billion rand. That's the unmet demand for credit amongst small and medium-sized businesses just in South Africa alone. So I saw this huge unmet demand, and I thought there must be a better way to solve this problem, start chipping away at that credit gap. And it was off the back of that I founded Bridgement. The first product that we came to market with was a digital invoice finance product, specifically leveraging the accounting software and accounting data that small businesses use for invoicing, and enabling a better way for them to access funding. And we've had a long journey since then. 8 years down the line, we have several other products that we've expanded into in the market, and I'm sure we'll chat a bit about those later on. But I think that's how the founding of Bridgement came about.
I think you're actually preempting my next question, because it's about that process of iterating as a businessman, and many founders pivot early. Did Bridgement's model evolve from its original vision, or did you stay true to your first blueprint?
It definitely evolved. The first product we launched in the market with was a digital invoice finance product for businesses that used zero accounting. Okay. But that's where we started. Okay. It was a very limited market, but we had to choose a beachhead that we wanted to land on and tackle that first, and then expand into the market from there. So we started with this invoice finance product, and we started there because there was a lot of invoice factoring and discounting companies, traditional companies, but we found that it wasn't accessible to small and medium-sized businesses. And there were a whole host of reasons why that wasn't accessible. But I also saw that businesses struggled with cash flow because of their customers taking long to pay them, late paying debtors. And creating an innovative form of invoice finance was how I wanted to first tackle that credit gap. What we quickly discovered was that many SMEs wanted this product, and we had to quickly expand from just servicing the Xero ecosystem. And so we then integrated with Sage, with QuickBooks, and we enabled businesses using whatever financial system they're on to connect their financial data with us. At a click of a button, when they apply for funding, they can connect their accounting package, they can connect their bank feed, whatever it is, and share their financial data. And what that enables a business like Bridgement to do is to very quickly and automatically see their trading history and assess their credit worthiness and grant them funding at a very low cost of origination. So that's sort of how it initially evolved. We then later discovered we had many businesses coming to us that wanted funding, that were trying to solve short-term working capital needs, but they didn't necessarily have receivable invoices that we could finance, just based on the industry that they were in. And so we then launched two other products. We launched an online business loan and an online line of credit. And that was to help businesses either finance a once-off big cost or purchase over a fixed term, as well as a revolving credit line that would help them manage working capital on an ongoing basis, where they'd be able to use the facility as and when they needed on a repetitive basis. And so by expanding that offering, we expanded our addressable audience. We were able to service more SMEs in the market, and really grow the business tremendously from the initial very limited small product that we started with. So I don't know if you would call that a pivot. I think the initial focus was always on solving the SME credit gap. I think maybe how we solved that evolved over time and expanded over time. And I think now what we're starting to see, and again, I don't know if I would call this a pivot or a natural evolution, is that banks have come to us and said, we love the tech that you've built. How can we work with you? And so we've been working with local banks as well as other large corporates in the country to enable them to leverage some of the tech and the IP that we've built. One example of that is one of the banks we've been working with for 2 years to white label our software and license out our software to them. And that's to enable them to service their market of businesses with a similar product, but leveraging our software on the back end. So it's a super exciting next stage of the business where it's almost evolving into also like a software as a service company, where we're licensing out that software and IP that we've built over the last 8 years to enable other institutions in the market to address the same problem.
And tell us about the process of partnering with a major bank. Was it an easy process?
You can see the grey hairs.
Tell us about that process and how important it is to partner with a big player.
Yeah, I think it's in terms of partnering with a big player, it depends on what you're looking for and the nature of the partnership always. One of the exciting things that I think this partnership brings is it brings a major partner with a big brand in the market, a strong distribution channel, a strong balance sheet and capital to leverage off of. And I think that between the two of us as an alliance, we would be able to create a lot of value and really significantly create a lot of significant impact in terms of solving this SME credit gap. Partnering with a bank is complicated. As a fast-moving fintech, as a startup, you can move quickly. You don't have all of the red tape, all of the governance and compliance rules of an organization the size of a bank that tend to calcify over time and get more and more hardened over time. And so when you start working with a bank, you very quickly realize that things can't necessarily move as quickly as a normal startup might be able to move. Things are way more complicated when you're dealing with the banking sector, way more regulated. And it definitely, I think, signifies a major step in terms of the maturity of a business. Our experience was we had a really solid business in terms of our operating model and good governance that was appropriate for our business, and good compliance, etc. But it had to mature to the next level in order to partner with the bank. Being a highly regulated industry, it also required approval from the Reserve Bank, from the Prudential Authority. So we had to get a GN5 approval, and that process, from the beginning, probably took over 2 years. So it was an incredibly long period of time to get the commercial agreement in place with the bank, to get the regulatory approval, and then to get the alliance operationally ready and integrate our systems with their systems and get everything to work together. So that was probably over 2.5 years in the making. So very difficult, and a very long sales cycle, ultimately. I think, having started Bridgement, if we had tried to do something like that from the get-go, from the outset, it would have been incredibly difficult. And being able to launch our business as offering finance to SMEs direct, and building it and building track record and know-how and developing the tech and the IP, and then further down the line, in parallel, building out these sorts of corporate bank partnerships, worked really well. And we're super excited about the next phase of the business as we continue to grow this and other partnerships.
So why do you think the big banks or financial institutions struggle to serve SMEs properly, and what's the challenge that you're addressing there?
Yeah, I think the difficulty in servicing SMEs, and it applies to banks and non-bank credit providers as well. There are several aspects to what makes it difficult. I think first and foremost, as a bank, if you're offering finance to businesses, the types of ticket sizes, the amounts that you're dealing with when you're dealing with small and medium-sized businesses is naturally much smaller than the quantums that you might be dealing with large corporates. And so if you have a similar cost of origination to service all these different businesses, naturally you're going to end up prioritizing larger businesses over smaller ones. I think it can at times be difficult servicing some of the smaller businesses with the smaller needs, purely just because those quantums are so small and the cost of servicing them is so high. So I think that's one aspect. In terms of why it's so difficult to service SMEs, there is a lack of data and information available on SMEs that is easily and readily available to determine what businesses you can grant funding to and whatnot. If you look at the consumer space, the consumer credit bureaus they have very rich data on individuals, on their repayment histories, and the credit scores you can get on an individual is a very strong predictor of who is a good and a bad borrower. In the business world, that doesn't exist yet. It isn't as regulated as the consumer world, as individuals, and you don't have the same level of data and richness of data in the business world, and so that adds to the complexity of assessing creditworthiness. In addition to that, when you're dealing with businesses, there is not a lot of uniformity from one business to the next. Depending on the industry a business is in, the maturity, their cash flow cycles, their operating model, how they're structured, every business looks different to the next. And it's very difficult to create systemized, automated ways to service large volumes of small businesses at scale. In the consumer world, consumers tend to look a lot more similar and a lot more uniform, and so that tends to be easier to service those. So I think it's a combination of all of those factors that ultimately makes servicing small businesses quite difficult.
Okay, and let's talk AI now. And I believe you use thousands of data points to make near instant credit decisions. you go into a traditional bank as a business, you need to provide your management accounts and annual financial statements and blood type or whatever. But then you're able to do it in minutes using AI. How do you do that?
Yeah.
How do you achieve that?
Yeah, it's without going into too much into the secret sauce of the business. We've been working with AI for a long time. And I think what's super exciting right now is the developments that have come about because of the advances in large language models, LLMs, has created an explosion in AI applications. And we have found a huge uptick in AI usage on a day-to-day basis, and we push we push very hard for it. We encourage our employees to leverage AI as much as possible, and we buy subscriptions to all the pro plans for every possible tool out there, just to encourage various employees and departments to experiment and leverage AI as much as possible, and ultimately enable us to achieve our goals of solving this credit gap more and more. In a business like ours, there are many applications in how AI can be used. We, just on a basic productivity level, we see all of our staff using AI. So our developers, our engineers are using some of the AI programs to essentially act as code assistants or agents to code for them. Our service teams, customer service, customer satisfaction, use AI to assist them with servicing clients. And in terms of our credit models and how we assess businesses, we've seen huge value from a few AI solutions where we've actually embedded them into our assessment process. It's been hugely valuable in assessing credit for credit worthiness for businesses, and also more importantly for fraud prevention, which is really important in our particular industry. And what that enables is, if we're able to better manage fraud risk and better manage credit risk, we should be able to approve more businesses for more funding and at a better cost. And so that's what we're really excited about in our space at the moment in terms of AI.
Well, in the traditional banking space, we get to know our bankers in some cases, and there's that human touch. You can engage with them, talk to them about your business challenges, and so on, and it engenders retention. Now you're a tech platform. How do you balance being all tech with having that personal touch with your clients?
Yeah, it's a good question. I think initially when I started the company, I envisioned not customers going through our tech platform completely self-service and never talking to them. I think I came with my classic engineering view on things, and we were going to optimize and automate everything, and no one would ever need to speak to a human. Very quickly learned that was not the case. I think still to this day, we have many customers that go through our platform and completely self-service and have no need to speak to humans because we've made it so easy. That being said, there are many people who still need to or want to engage with a human, and we've seen huge value in offering the highest standard of customer experience and relationship building. We found it is critical, especially when you're dealing with business owners who are very used to not being serviced well. And it's something that I reiterate with my team so often when we talk about our competitive edge in the market and our unique selling points. It might sound boring, but customer experience is one of the best ways to differentiate yourself in a market of competitors. And I really believe that the tech that we've built is amazing and it's innovative and it's at the forefront of the industry. But if you don't have a good customer experience and you don't build relationships with customers, it really will be the downfall of your company. So we have prioritized it, we've invested in it, and I think the tech and the software we built and the AI that we use is an enabler, but the humans are what actually drive and grow our business through the relationships that they build with customers.
Okay, does anyone have questions for Daniel here?
It's basically just answer I'm giving. With the AI model, for businesses like that, those people that design the AI model should also be working in the business to understand how the business runs and how the end user reacts to those systems. Because it doesn't help just putting in an IT person to design it and they never worked in that environment. Because you probably know about the discovery bot. That AI is a total joke because it doesn't even understand what you're asking because those people have never worked in that environment. Those are the sort of things that you get with AI. So AI's will only be perfect once those people that work in that environment, then they can design their system because they understand how the end user, which is the client, will react to that system. Thanks.
Thank you.
Yeah, I think it's an interesting one when businesses are leveraging some of these tools, both for automation and leveraging AI. I always wonder sometimes when you see some of the solutions in the market, were they trying to solve a efficiency or productivity problem internally, or are they trying to offer the best possible experience to the customer? And so often, unfortunately, I think it's the former. And you see some of these solutions, they're probably just, it hasn't been designed with user experience and customer experience and satisfaction at the forefront. It's something that when I talk to my team, we from day one are working and engaging with customers and making sure, if it's an external facing application, making sure that what's being built is actually fit for purpose and is actually going to solve their need before it's actually solving our own internal need. There are many other applications internally within the company, and if it's solving a particular need in, for example, the credit team, then those credit team members are the ones that are going to be sitting with the engineers and sitting with the designers and ensuring that the solution that is designed and ultimately implemented is actually fit for purpose.
Thank you.
Any other questions? No questions. Okay, there's often tension between growth and responsible lending. How do you ensure that Bridgement scales without compromising on credit quality or ethics?
Yeah, that's a good question. So first and foremost, we have very strict rules internally and policies in place to ensure affordable lending. We, as part of every application that comes through our business, one of the first things that our system does is assesses their affordability and looks at existing credit and ensures that the business is never going to end up in a state of over-indebtedness. In addition to that, Bridgement is also is part of a few members of SME credit providers to form a self-regulatory body called SASFA, the South African SME Finance Association, where we define a code of conduct for SME financiers in the market and define strict rules around protecting businesses and ensuring that over-indebtedness doesn't occur, that responsible lending is adhered to, and the very strict rules for members of that association. And so we use that to also not just hold ourselves accountable, but other SME financiers in the market. It's really important to us because we've seen it and we saw it in the consumer world. The damage that can be done by unscrupulous credit providers is quite severe. The one benefit of being in the SME finance world is most of the funding that businesses come to us for is for productive use cases or productive needs. In the consumer world, a lot of the funding that is obtained, a lot of the loans that are obtained are more for consumption. And so, yeah, when you're dealing with business and they're using finance and funding for production, to produce more revenue, to grow their business, to finance a purchase order, to finance a project, whatever it may be, I think you find that the abuse is maybe less severe and less common than you would typically find in the consumer world. But that being said, it's still really important to ensure that businesses are protected. And that responsible lending is followed throughout the industry, especially when you're dealing with the smallest businesses and micro businesses.
Okay, and how do you see AI and machine learning or other emerging technologies changing the game for digital lenders in the next 5-10 years?
Yeah, I think it's going to be very interesting to see what happens. I think not just with digital lenders, but with all industries, what AI and all these various LLMs out there are doing is they're reducing the barrier to entry for new business, for new competitors to enter into markets. And what will be interesting to see is new businesses that enter the market that are AI first, that don't have legacy systems, legacy infrastructure, legacy people, will enter into the market in all industries, not just digital lending, with AI-first solutions. And I think it's going to be really exciting to see what happens. I think there'll be definitely an increase in competition. I think that in terms of specifically, specifically in the digital lending space, I think that AI will enable better credit decisioning, and that will translate into improving that credit gap that I mentioned earlier. It will become easier and easier to offer funding to businesses, and for those businesses, it will be easier and easier to obtain that funding. And so I'm super excited to see that credit gap improved. I think that what will also be interesting is AI will enable more fraud in the market. So it'll be interesting to see how financial institutions actually how they manage that and how they improve their fraud detection systems to get around those solutions, those particular fraudsters. So it will be quite interesting, I think, to see what happens on that front. And then lastly, I think that there'll be, and I can say this for Bridgement as well, there'll be a huge, there'll be new products that will be created off of the AI solutions that are available in the market. I think AI will unlock many new developments and changes in the way that we do things. And this does apply to every industry, but I think it certainly will apply to ours.
So do you see any positions within your company becoming redundant within the next 5 to 10 years because of AI?
I don't see any positions becoming redundant in the short term. I see teams becoming way more productive and us requiring smaller teams to achieve the same thing as we would have achieved before. I definitely see that happening in the short term, and I can say that I'm seeing it already. We had a small project for one of our partners a couple of months ago, and there was something we urgently had, part of the system we had to build urgently, and my CTO spent the weekend building out this particular module that had to be built out. He came back on Monday and he said, I wrote 10% of the code and the AI wrote 90% of the code. And he just said, it is such a productivity unlock that it's quite hard to comprehend, and I think that's just going to get better and better. I don't think we're at the point yet where these AI solutions can be completely agentic, where they are just doing 100% of the job with no human supervision. So I think that human supervision will still be there for a long time, and the refinement and the tweaking to ensure that what you're getting out of the AI is actually what is needed by the business. I think that will continue to get more and more. 5-10 years down the line, probably some roles will start to get completely replaced. It's a bit hard to tell. I think every week I'm amazed at the latest developments. It's quite hard to even stay up to date with everything. But 5 to 10 years down the line, absolutely, I could see certain roles being either made redundant or diminished significantly.
Okay. If there are any questions, happy to take one or two. Okay.
Well, I would like for you to give us further insight from where you stand or from where you're sitting about new fintechs that would come in with AI first, and what are the potentials for them in the marketplace?
So just to make sure I understand the question, you're asking about my view about new fintechs entering into the market leveraging AI.
AI, yeah.
I think there are probably a few different ways that could come about, but one of the things that I would be interested to see is you're seeing a lot of businesses create teams of AI agents, where you have a hyper-specialized agent that does a particular role, and you'll have many different agents doing many different roles. And then you will have orchestration layers where you'll have AI actually orchestrating those various agents. And what I think may start happening, and it's not just in this industry, I think in many industries, is you'll have startups being founded where from the get-go they're building out these teams of agents that are orchestrated. And still they'll have human input and human controls in place, but what they won't have is they won't have the legacy infrastructure, the legacy people and complexities that come with people in their businesses. So I think it'll be very interesting to see how those startups run. I think they will run and operate in a very different way to existing and established businesses. In an established business, and especially the larger the business, the more complicated it is very difficult to implement change. You need change management consultants. It can take many months re-educating the team and communicating it to the entire organization. It's incredibly complicated. And trying to introduce AI into those environments or any significant change which may put someone's job at risk or make them look bad can create, can disturb the equilibrium in many corporates, and a lot of people can fight that. I have seen people say that they absolutely refuse to use AI, and the only reason is that they're scared it is going to make them redundant. And so introducing AI in the same way that 5, 10 years ago, 15 years ago, introducing tech to automate certain things, do things differently, make people feel challenged or at risk of their job, or maybe just their experience and knowledge of the industry was now outdated. I think that the same thing is going to happen with AI. So it'll be more difficult for larger established corporates to implement these AI solutions. And new businesses that are starting, that are AI first, I think are going to run and operate and grow in very different ways. It's a bit hard to tell exactly what the end state is and how they'll grow, but I think it's going to be very different. And the likelihood is they will be able to scale far more efficiently and cost effectively at better margins than some of those corporates. When they do eventually scale, which could probably happen really quickly, it will be quite difficult for an incumbent corporate to remain competitive.
You spent time in Nigeria, and I just wanted to find out, in your opinion, what are the differences in terms of doing business in other parts of Africa and in South Africa? If you look at other African markets, there are hundreds of fintechs, doing it themselves. But in South Africa, there seems to be this need to integrate with the major banks. So there's a proliferation and then consolidation. So just that's the that's a feature of this market. So what are the differences and what's responsible for that, in your opinion?
Yeah, it is interesting. In South Africa, there is a lot of concentration among a small group of banks, very large banks. Whereas in Lagos, in Nigeria, I remember the fragmentation in the banking sector was massive compared to South Africa. So many more options for banks there. So I think very different markets. Obviously, in terms of population size and demographics and GDP per capita, very different markets. And I think that South Africa's financial services and banking sector is extremely advanced from a technological point of view. But one of the complexities is because of the concentration in the banking sector and that the concentration of power that comes with that, as well as regulatory changes being somewhat slow, that obviously has an effect on the ability for new businesses, new fintechs, new innovation, new things to happen in the market. A classic example of that would be something like open banking. In Europe, the US has been a huge push towards open banking. In Europe, PSD2, which has required banks to open up the financial data of their clients, and not just the financial data, but the financial infrastructure. And that has created a whole new wave of fintechs that have created new payment options that have created ways for new products on top of the financial data that sits at the banks over there. And in South Africa, unfortunately, we haven't seen that regulation come in yet. And while there's been talk about it, and some of the banks have spoken about opening up their APIs and opening up their data, it's still got a long way to go. And it's very selective over when they open up their data. They're not being forced to do it. It's out of their own sort of goodwill and only if it's in their best interests. So, I think the regulatory changes are slightly slow in South Africa, and the quicker they come, the more potentially the more innovation there would be. I can't comment specifically on the regulations in Nigeria. It's been a long time since I was there, probably about 10 years or so since I was there. But I believe it is also complicated there. The CBN, the Central Bank of Nigeria, also has some complexities, especially in terms of moving funds in and out of the country. But there are some amazing fintechs that have started up there and solved problems. I think there are many overlapping problems and solutions in that market, but there are some that are also specific to those markets and may not be as prevalent and relevant in South Africa. An example, would be, something like this mobile money, like M-Pesa, in East Africa. Not talking about Nigeria anymore, but in East Africa, that has grown incredibly, exponentially, and really had such a huge impact on the economy there. Whereas in South Africa, that has not grown, and the take-up has not been as high with some of the mobile money solutions. Yeah, so there definitely are some key differences, but it's interesting. There's some incredible fintechs. One of the amazing payment gateways, payment providers in Nigeria, a company by the name of Paystack that was acquired by Stripe, one of the largest payment processors in the world. They've expanded into South Africa, and it's been interesting to see how they've had to adapt some of their offerings for the local market. But mostly their product has worked really well. The difference being, though, that they've come to South Africa where there are many payment processors and it's a way more competitive environment, but they've come with a really strong platform with very advanced software. So it'd be interesting to see how a player like that actually expands in the market and competes with some of the incumbent local players. I think also in the past, in terms of venture capital, there was a lot of venture capital being raised in the rest of Africa. A lot of US venture capitalists investing in the rest of Africa and less so in South Africa. And over the last few years, I've started to see a lot more investment coming from some of that US venture capital, some of those US venture capital firms. And hopefully we'll see a lot more investment from those in South Africa, because it really helps to bolster up the tech ecosystem, not only FinTech, but the whole startup ecosystem.
Okay. And in closing, what's next for Bridgement? One of your competitors has launched a banking platform where you can, they started off with lending, and then now they've got, you can open a bank account. Is Bridgement Bank going to happen? Do you have plans to go into the rest of Africa?
Yeah, good question. So what's next for Bridgement? So a couple of years ago, I had the crazy thought of starting a bank, and went down the path of exploring what it would take to start it. And we went down quite a long path, and eventually, after properly understanding what it would take, we had a strategy session with our team and our board, and we made the strategic decision not to pursue becoming a bank. And the reason was really twofold. The first is that becoming a bank is hugely complicated, a lot of red tape, and we viewed that as being a major distraction. We believe we're the best at what we currently do, and we want to remain the best at what we currently do. And so we wanted to avoid that distraction and continue developing that product, as well as some complementary products to what we currently offer, and remaining the best and continuing to offer the best possible finance solution for businesses in the market. The second part of that decision, which I think was really a key driver as well, is that we are now the leading FinTech SME credit provider in the market that is not a bank, or not becoming a bank, or not owned by a bank. And so what that does is it positions us in the perfect position to partner with banks, because a bank doesn't want to partner with us if we're becoming a bank and competing with them. But they do want to partner with us if they don't view us necessarily as a competitor or competing bank. So we find ourselves in a good position now, where we've been approached by most of the major banks in the country to run partnerships or pilots and proofs of concept and all of that. And so it's a really exciting time for the business, and I think over the next few years, we really are focused on expanding our product offering without becoming a bank, partnering with banks, and licensing out our software and the technology that we've built to these various banks and other corporate partners. We're also super excited about continuing to invest in embedded finance offerings, so that businesses can access the funding that they need at the point at which they're trading. We've built the platform to be completely embeddable in other ecosystems and other platforms, and so our embedded finance offering is something that we're super excited about. And lastly, I'm excited to leverage AI in almost every aspect of our business, and continuing to do so, and seeing how it disrupts the industry.
Thank you very much. Please give him a round of applause. Thank you. Thanks. Daniel.
Thanks.